Now, next up, we have Dean Weinbren. Dean is an executive director at Pengana Capital Group and managing executive of Term Plus, Pengana's private credit platform. With expertise in global investment strategies, ESG solutions, and a diverse background in finance, risk, insurance, and media, Dean holds degrees in organizational psychology and financial planning. In this session, Dean will explore the evolution of global private credit, its key characteristics, and how recent innovations are making this asset class accessible to everyday investors. Dean, over to you.
Thanks, Lel. Really happy to be here today. And hi, everyone. Thanks for dialing in. As Lel said, my name is Dean Weinbren. I'm an executive director here at ASX listed funds manager, Pengana Capital Group, or PCG. And today I'm going to be talking to you about the world's most popular and oldest asset class that you probably don't have in your portfolio, and that's global private credit. So over the last 5 years or so of PCG's 21-year history, our firm has emerged as a leader in delivering innovative ways for Australian investors to access typically hard to reach and differentiated investment opportunities. Next slide, please, Lel. And within the last 5 years, PCG has launched a global private credit capability that is unprecedented and unparalleled in the Australian market, with the aim of democratizing access to this exciting asset class for everyday Australian investors. This access is delivered through vehicles like our ASX-listed Global Private Credit Fund, PCX, and a category-changing online term account product called Term Plus. But one of the really interesting challenges that one faces in the process of launching something new into the Australian market is that, by definition, you're opening up to a much broader audience who's naturally less informed about the asset class, as it's nothing they've ever had to consider before. But there's a reason that you see private credit as an industry featured so often in investment commentary. Even the speaker before me was talking about Australian private credit. It really is a hot topic, and it really is an exciting space. So the challenge that I'm taking on today is for you, the audience, to come away from this session with a good foundational understanding of what global private credit is and the reasons behind the attractive characteristics that it presents as an investment option. Next slide, please. So a quick disclaimer slide, because no compliance officer in the history of finance has ever met a disclaimer they didn't love. The information in today's presentation is general in nature. It doesn't take into account your personal objectives, financial situation, or needs. And so before acting on any information contained in this presentation, you should consider whether it's suitable for you and your personal circumstances. Certainly the intention here is to be educational. Next slide, please. So to put global private credit into context, as you can see on this chart here, it's one of the fastest growing asset classes over the last 15 years, and this is driven mainly by the US and European markets that you can see here in the chart in blue and the dark orange segments. Global private credit is widely accepted as a staple and growing part of how the big institutional investors allocate their money. But even though it's hugely popular as an asset class within the large institutions around the world, it's a very new asset class to Australians. Because unless you're a major financial institution, global private credit has not really been available to you in any meaningful way up until now. Next slide, please. In its absolute simplest form, we can distill an explanation of private credit as a general rule down to a single word, and that's lending. Lending is one of the oldest forms of transactions in human history. And over time, that transaction has matured and been commercialized into the large $11 trillion industry that it is today. So to understand the global lending market, I think let's first look back at the evolution of lending and how we get to the interesting market dynamics that we see today. And of course, the first most well-known, certainly to people on this call, most well-known commercial model of the lending economy is the banking sector. On the next slide, please. So the banking sector at its core follows the normal principles of lending as illustrated on this slide. It's a system where an individual effectively lends their money to a bank based on a certain set of terms and rates through bank accounts like transactions or saving accounts and term deposits as shown on the left-hand side. And the bank in the middle then loans out those deposits to borrowers on the right-hand side on a different set of terms and rates. Those on the right-hand side who borrow from the bank typically pay the bank a higher fee than the bank then pays on to the customers on the left-hand side that the bank is borrowing from. I apologize to anyone listening who's anything like one of my close friends who still can't quite get his lefts and rights. That would have been really confusing for you. But the key detail here is to note that the contractual terms of the transactions on either side of this picture are vastly different when it comes to duration. With really short-term liquidity requirements on the left-hand side, bank customers want access to their hard-earned savings, and an average of, say, 5 to 7 year terms of the right-hand side, which means a much longer wait before the bank sees their principal money that they initially borrowed from their customers paid back to them. And so there's this inherent tension in the banking system where both sides of the equation have conflicting characteristics. And that's a big part of the reason that bank regulators exist. Next slide, please. So in Australia, our banking sector is fairly simple. Australia has 4 main banks that, depending on your unit of measure, make up somewhere between 76 and 90% of the market. And if you think about what that means from a regulatory perspective, it's quite easy for the Australian banking regulator, or APRA, to ensure that the system has the right checkboxes and processes in place, which in turn lets our Australian banks operate quite efficiently. But in the US and Europe, the banking sector looks very different, as we can see on the next slide. Where we have 4 major banks here in Australia, in the United States market alone, there are almost 5,000 different banks. If you look at the background graphic on the slide, there are 15 columns and 26 rows of icons. That means that there are 390 bank icons shown on the screen. If each of those icons represented a different US bank, you would need about 12 duplicates of this slide, side by side, just to represent every bank brand that's in the US. And that's quite phenomenal. And so this is where it's really important to note that each of these banks, as represented by the icons, carries that same level of underlying liquidity tension and risk in their systems as the bank example from a few slides back. Next slide, please. So this fundamental mismatch in the banking model isn't some hypothetical risk. All that underlying mismatch or tension in the banking model came into an inflection point in and around the 2008 period when the GFC hit. And bank customers realized that their deposits were perhaps not as liquid as they thought they were. Customers then flooded the banks with withdrawal requests, what's called a run on the bank. And systems in places like the US and Europe ended up, as we know, an absolute mess. And even today, we've seen the fragility in that banking system with news headlines as recently as around March last year with the collapse of Silicon Valley Bank in the US. So the GFC absolutely exposed the banking sector. When you have an industry such as the States of nearly 5,000 banks caught up in that sort of environment, this is the type of crash and highly fueled shift that brings on major structural change moving forward. Next slide, please. So after the GFC, the regulators, probably with a bit of egg on their faces, got to work and applied significantly stricter regulations in the US and Europe in an effort to try and reduce the inherent risk in the system and avoid another such implosion like the GFC. More regulations and stricter and tighter controls created additional burdens on the bank models, and that cut their ability to lend to a wide range of borrowers. Ultimately, what happened is that many banks pulled out of that business line altogether, as we'll see in just a moment. Next slide, please. So, as I said, that failure of the system back in 2008 was a real inflection point for the exponential growth seen by global private credit as a sector over the last 15 years. If you remember that chart that I started the presentation with, and it's still going. So as a next step, let's look at how that actually unfolded. And this will give us context into the unique set of opportunities that we see in the global private credit or lending markets today. Next slide, please. So the retreat of the banks from global corporate middle market lending left a huge gap to fill. And the ever-growing regulations on the banking sectors, even that we see today, are only widening that supply and demand gap for corporate credit overseas. But this retraction of the banking system didn't change the nature of the big, stable, mid-market corporate borrowers that up until that time were using bank finance to access capital for perfectly legitimate commercial reasons, either to grow, expand, or improve their businesses. So now, where would they get the funding? And that's the catalyst for the rise and maturity of the global private credit sector. Next slide, please. So now enter a better lending model. Next slide. So with a huge funding gap to fill, the smart people on the likes of Wall Street had already recognized the potential for this gap back in the early 2000s and had moved to set up specialist funds management businesses that would build and model an institutionalized lending capability specifically around the needs of corporate borrowers and without some of the burdens and liquidity weaknesses that their bank counterparts had faced by having short-term depositors on the other side of the equation. And that really, at essence, is global private credit. For the purpose of this presentation, the largest and most mature markets for private credit, again, as we saw earlier in that slide, are the US and Europe. And in the context of global private credit products that Pengana and Term Plus have made available to Australian investors, we specifically refer to loans to companies with annual earnings typically between $50 million and $250 million. So, really big, meaningful, billion-dollar valuation type companies. So now that you have the background of how global private credit came about, let's follow that story to understand some of the natural and inherent characteristics that we see in this asset class. Next slide, please. If we look at the US as an example, replacing that sudden and growing gap left by the removal of nearly 5,000 different bank lenders is no small fix. And so the demand for corporate lending in these markets still far outweighs the supply, which, if you understand the dynamics of supply and demand, creates a really interesting opportunity for private credit funds and fund managers. And that's because they're able to demand favorable terms contractually from these corporate borrowers. Next slide, please. And so what you end up with in the global private credit sector is specialist lenders who make individually customized loans. So they have a very detailed knowledge of each company that they lend to through an extensive due diligence program that they undertake before making a loan. And each and every loan that they do make is contractual and covers things such as contractual repayments and securities and covenants over various assets that these loan contracts may demand, with private credit lenders typically sitting senior in the capital and in the capital security stack of that company against both capital and assets. And because they're specialist lenders who charge a premium and hold security, the borrowers in turn benefit from being able to demand a premium, fast and bespoke service to access capital for their various funding needs. Next slide, please. In response to this supply and demand mismatch, what you see here is how quickly non-bank or private lenders have filled the roles of the big banks in the global markets over the span of the last 15 years or so, where non-bank lenders now make up an astonishing 84% of the primary loan market in the US and Europe. As you'll see on the next slide, that lending economy globally is very different and significantly larger than in Australia, where banks still control about 90% of corporate loans as a result of the regulator being more comfortable with its ability to oversee a much smaller and more concentrated pool of banks. Whilst overseas, it's an almost totally reverse situation where lending is dominated by the private markets. One misconception that we often find in our conversations with investors who are new to global private credit is that people think they know what private credit is because they know Australian private credit. Now, Australian private credit, part of which was presented in the session before me, as an asset class can have its own really great qualities, but really they both may be in the same category. Ultimately, as you see partly on the pie charts here, they're completely different from one another and operate in vastly different market dynamics. Certainly, if you're already invested in Australian private credit from a diversification perspective, global private credit should be a real consideration for you. Next slide, please. The next important thing to look at is, what does private credit actually look like as an asset class that it's so popular and growing at such a rapid rate? I won't spend too long laboring the slide because we are limited on time. And for the more analytical people watching this today, I do believe there's a recording of the video that will be made available, so you can come back and pause here on the recording if you like. But in summary, what these charts are showing us is that when we look over a period between 1995 and 2021, so a period that covers significant stress events like the GFC, as I mentioned, and even COVID, private credit loans to US middle market companies experienced the lowest cumulative default rates, and within the lowest cumulative default rates, then had the highest annual average recovery rates. And this is partly a result of having specialist lenders investing in well due diligence customized loans with contractual repayment terms that are favorable to the lenders and also security over borrower assets. Next slide, please. So if we look at how US private credit has stacked up against other asset classes, the blue bar here represents the associated volatility of each asset class, and the orange shows the associated returns of that asset class. What it shows is that US private credit has delivered higher annualized historical returns than any other debt asset class. And that's especially exciting in relation to the associated risks as measured by volatility in the blue bar. So you can kind of start to understand why global private credit has seen and continues to experience the level of growth and interest that it has had from investors. Next slide, please. So what are the key takeaways for the global private credit sector as an asset class? Well, we saw how the inherent weaknesses in the banking sector forced regulators to pull the banks away from the attractive corporate lending space because of that duration and liquidity mismatch with their customers. We saw how this then created a significant mismatch between the demand for corporate loans and the available supply of capital, which is a structural tailwind for private credit lenders in the global private credit sector. And how the huge gap that was left behind by the removal of the banks as loan providers has then been a catalyst for an evolved and improved private lending industry that's more effectively structured to feed the demand for corporate loans whilst providing a better outcome for those lenders. And as we just saw, historically, global private credit has delivered higher returns with less volatility and correlation compared to other asset classes. And again, this is a result of some of the key characteristics of global private credit loans. And to reiterate these loans are contractual in nature, which provides a level of certainty to the lenders around future cash flows, and can also include loan characteristics such as various securities on capital, as well as floating repayment rates, which provides an additional level of protection against inflation. Also, a low correlation with other asset classes means that global private credit can provide a great element of diversification to an investor's portfolio.
Fantastic. Thank you so much. Now, you talk about unprecedented access to global private credit. Can you outline what that actually looks like?
Sure. That's a great question. So, firstly, access to any global private credit in a diversified form for retail investors in Australia is pretty much unprecedented as it is. But what we as a fund manager are looking to deliver, or are delivering, is a diversified portfolio of over 2,000 underlying global private credit loans. And as I mentioned earlier, these are typically loans to non-cyclical, stable businesses that fall into that mid-market category that I mentioned earlier. So these are companies that would typically have annualized earnings of between 50 and 250 million US dollars. And that's a really important point, because if you consider the stability of a billion-dollar valuation company and then compound that across over 2,000 different companies in the US and Europe, that's a really interesting pool of global private credit loans to now come available to Australian investors.
Okay, and a bit of a crystal ball question now. What would happen if the S&P 500 fell, and how would private credit perform then?
Absolutely. So, look, we have seen that there is a very low correlation. One of the main things to understand is that private credit, by virtue of being a private market, isn't subject to the same volatility as being listed on a stock exchange. These are longer term, typically illiquid contractual loans. And so because they're contractual, there's a high level of dependability and a high level of reliability and foresight that you can get out of the loan. The other thing that I mentioned is that these are specialist private credit lenders, and they bilateral loans that they make with their borrowers. So they have really close relationships with each one of their customers. And if you remember that slide that I showed you with default rates and recovery rates, a big reason for that high recovery rate is because the relationships that they have with these lenders means that they're able to work out make goods with lenders if there are periods of significant stress. And as I said, probably the two best examples of this would be the GFC and COVID, where we did see a lot of market stress, especially in listed markets, whereas the global private credit market remained a lot more stable because of the contractual, bilateral, and personal specialized nature of those loans.
Great. Now, based on your presentation, global private credit is such a huge industry. You'd really think that you need to be a specialist in the space to pull together the best investments. How does Pengana or Term Plus fit into that?
Yep, that's a great point and a great question. So I touched on at the start that Pengana is an Australian funds management business, right? We're ASX listed. We've been around for about 21 years. We focus as a fund manager or a fund manufacturer only on offering products for Australian non-institutional investors. We currently manage around 3.4 billion Australian dollars across 14 different strategies. And so as a business, our core specialty is manufacturing and delivering unique investment vehicles like PCX and like Term Plus for Australian investors. Now, that doesn't make us a global private credit specialist, right? So part of the key to building out this global private credit access, which we've been doing over the last 3 years or so, was to engage with a global investment leader. And to do that, we have engaged with Mercer as our investment consultant on these global private credit products. Now, for anyone on the call who doesn't know who Mercer is, they have more than 30 years experience specializing in private markets. They currently have, I think the number is over 16 trillion US dollars in assets under advice, over 2,000 investment professionals around the world. And so they offer up an exceptional global platform and scale and access for us to be able to source and secure best of breed and highly rated investments for our global private credit portfolios. And if you look across our range of funds and how we operate, you know, part of what we do is sourcing the best partners and the best providers to deliver the products that we deliver for our investors.
Okay, now, as you point out in your working example, private credit is an illiquid asset class. How long does someone have to invest in your private credit products?
Sure, another great question. So, as I've mentioned, we've been working a long time, and our primary aim has been to democratize that access. And because global private credit is an asset class that has, you know, historically had really significant barriers to entry for everyday investors, as you rightly point out, one of those, and not the least of which, is restrictive capital lockup periods. So a big part of one of the issues that we've had to solve and is that liquidity and that capital lockup. And we've done so in a number of ways. So first, if we look at PCX, which is our ASX listed fund, by taking an illiquid portfolio of global private credit loans and then effectively breaking it up into units and listing it on the ASX, what the results you get is that investors are able to buy in or sell out of that product daily by trading units on the ASX. So with the listed structure, because the buy-in and sell-out is happening at the unit holder level between unit holders, that doesn't have any effect on the nature of the underlying portfolio in the vehicle or the return profile of the underlying portfolio that investors get. So we're able to accommodate the illiquidity typical of global private credit loans without passing those constraints on to our investors. And that's really something unique to using a listed structure like we have for PCX. If we look at our online term account platform, Term Plus, the term-based model allows us to deliver private credit returns using term accounts with different commitment periods that we can then match up with our private credit portfolio. And because it's so diversified, as I mentioned, we've got over 2,000 different individually negotiated loans with different loan characteristics. Our investment team is then able to pick and choose ingredients that we need based on the current profile of our term account book. So currently, Term Plus accounts or Term Plus offers 1, 2, and 5 year account options, where the target returns obviously scale up the longer the duration as a premium for longer illiquidity. And those returns are paid as a monthly income, and that can either be taken as payments directly to customer bank accounts, or you can also elect to reinvest those each month for compounding returns.
Excellent. And final question, what are the risks in investing in global private credit?
Sure. Look, like any kind of investment, investing does carry risk, whether it's in global private credit or anything else. But obviously that varies across asset classes and sectors. So I've already touched on the risk return profile of global private credit in one of those bar charts, which is an outlier relative to other asset classes and a big part of the appeal here. But it is an investment, and naturally there are still risks that need to be considered. Things like bad manager selection is a risk. Being too concentrated and not diversifying enough can affect the smoothness of returns or present a reliance of your returns on a certain subsector of the asset class. And that's something that we can see happen in Australian private credit, where a lot of the concentration in the private credit market locally is around the real estate market. You know, part of that's a circumstance. If you remember those pie charts, private credit only makes up 10% of the lending market here. And then there's things like capital management, liquidity constraints, even currency risk when you're dealing with global markets. So that's also part of the reason that specialist fund managers like Pengana exist, to try and manufacture products that we believe will deliver the best possible returns in the face of each sector's dynamics. In terms of our specific products and the risks involved, obviously we've got all the standard product disclosure documentation for potential investors that outline everything you need to know about the potential risks in each product, as well as some really unique features that we've designed for our products that aim to give our investors a great experience when investing in terms of stability of capital and reliability of returns. But again, all that detail is available on our website or product documentation. I won't labor it here.
Fantastic. Well, thank you so much for a very comprehensive presentation, a bunch of answers to those questions, and very educational and informative information that you've provided. We are now going to break for 15 minutes ahead of the afternoon session and grand finale. Thank you very much. It's been a pleasure joining you, and enjoy the rest of the day.
Thanks for listening in. Thanks, Lau.
Thank you.